welcome everyone. I'm Alex Harwire. It's so good to have you here. Welcome to DevOps Days 2022. We have a really great lineup today. After a 2-year hiatus, I'm really happy to see an in-person event. We talked about doing this remote the past couple years, and I was vehemently opposed to it because one of the big things about DevOps Days to me is being able to get to meet people in person and just have conversations off script. So that's what we're really hoping to encourage today, having off script conversations, being able to talk about what you want to talk about. We have open spaces about halfway through the event where that's really, if there's not talks that are like really hitting on the things that you care about, that's what open spaces is for, to give you that time to be able to do that. Some housekeeping. We have a code of conduct with DevOps Days. We're really, the main thing is that we want this to be a fun event for everybody. This is a harassment-free zone. Any of the core organizers reserve the right to boot people that we feel are not being respectful or kind to each other. All right. Another thing, the program. So if you don't know what the actual event is, we have on the back of theirs this little QR code that will get you to the program. So you can just scan that with your camera. That gives you the full run of events of what we're going to be doing today. Okay, so just sharing a little bit like personal reflections about what about this event. You know, I went to my first DevOps conference in 2016 in San Francisco, and it really opened up my eyes to like the world of technology. I had been in infrastructure operations at that point, and over the years, you know, my understanding of DevOps has really changed, and my understanding of technology delivery and his relationship to people. One of the things that I really love about the DevOps community is that it really is about bridging connections. It's about, you know, breaking down walls and talking to each other. And so if you're new to the concepts of DevOps, if you're new to technology, if you've been here for a long time working in technology, I just encourage you to ask questions, be curious, and have discussions with each other. I've probably said discussions multiple times already. I think that having those conversations is the most powerful aspect of these conferences, and I just really encourage you all to just, you know, to lean into that. With that, I am going to go ahead and introduce our first speaker, Chris Rimondi. Chris is the Senior Director of Compliance Engineering at VMware. Previously, he served as VP of Engineering at Cofense and Director of Site Reliability Engineering at FireEye. He lives in Chattanooga with his wife and 4 children. Come on up here, Chris.
Well, I appreciate the introduction. Like Alex said, I do live here in Chattanooga, and I am very grateful for the DevOps Days and the organizers here to make this event possible again. I think the last time I was here was 2019, and it has been, it's definitely been a while. It is, to Alex's point, great to see people in person again. I really do look forward to the conversations that we are going to have in the hallways and so forth, and kind of continue to do this. The title of my presentation is Software Financials for the Engineer. And I think to the spirit of what Alex was saying in DevOps, it's a lot about building bridges. It's a lot about kind of finding and understanding other parts of the business. And several years ago, I sat across the desk from one of the co-founders of the company I was working for. And he had a document that was basically a consultant's analysis of where we are, where the business was, and so forth. And the content of that document, and the summary of it was basically something like this, and I'll read this to you. R&D over revenue was way too high to justify our LTM growth rate. Our LTV over CAC is greater than 5. Therefore, our strategy is to increase S&M while maintaining FCF ratios. Yeah, it's like, okay, what are we doing with this here, right? Why is this important? You know, you have these periods, these inflections in your career when you think, wow, I really need to kind of get caught up in what the rest of the business is doing. And it was at that point for me, I said, you know what? They are speaking an entirely different language. And I realize not everybody here is in, like, for example, works for a SaaS or a software company, but I think we're all kind of adjacent to it. And what's happening in the overall kind of macroeconomic picture of the software engineering space and the software service space, I think is very relevant to all of us. And during this presentation, I'm going to do a couple things. First of all, I wish I had this presentation several years ago for myself to kind of lay the groundwork for. So there was stupid things I said and probably dumb things I suggested that might have been prevented if I was capable of digging a little bit deeper into the financials and understanding of the business. The second thing is, I'm going to put some of the data points that we have today in juxtaposition to where our economy is right now. So I think it's no mistake. I think there has been a significant number of layoffs. I think volatility is probably the word that I've heard the most describing particularly the tech space as of late. And that's a really difficult place to be in sometimes. And I'm hoping that not only will we talk about and lay like a bedrock foundation for what SaaS is and what some of the financials and the business side of the house is, but also we'll have a little bit better understanding of why people are doing what they're doing during the time right now. So let me give you a very practical example. I want to ask this question. For those of you who might be on the infrastructure, or even just generally engineering space, is anybody looking at cloud spend? Yeah, I'm willing to bet that if you're looking at cloud spend today, you're looking at cloud spend more today than you were 6 months ago. Definitely more than you were a year ago. So the question is, why? But how do I know that as well? How do I know that? I know that because probably the best bellwether of what's going on in the industries is the hyperscalers. And the hyperscalers are telling us both the same thing. What they're telling us in their recent filings from a public filing standpoint is they have basically the same commentary together. AWS is saying macroeconomic uncertainties are causing a compression of their margins. AWS's margins are still really good. They're like at 26% or something like that. But since they have all of that hardware, they're actually feeling their customers' cost cutting, and that's cutting into their margins. Azure is basically saying the same thing. They're saying the macroeconomic environment is causing them to compress on their margins, and many of them are actually struggling as they're actually seeing their customers going to them and saying, how can we cut costs? So it's really interesting to me if you ask that question. So we're all looking at cloud costs. We should be doing that in general, but why are we all doing it more now? Like, what's different now than a year ago, than 2 years ago? Clearly, we've had the pandemic, but the inflection point has changed. We're going to look at a few data points to try to get some comprehension on what's changed and why. So let's take a look at this graph here. This is actually a trend line of the 10-year Treasury. And what you can see is that the 10-year Treasury is basically US debt. The yield on the 10-year Treasury is going up. It's going up significantly since the beginning of the year. Now, Friday, it took a hit. I think I grabbed a screen capture on October 28th, but things happened, and then the market had a big rally day on Friday. So this actually dropped a bit from there. But what you see is a significant growth in basically the rate of the 10-year Treasury in US debt. The second thing, and this is probably what most of us see when we think of rate increases, you'll hear about the Federal Reserve raising rates. And that stark contrast on the closer to us here, but starting in 2022, is the Fed funds rate. And the Fed funds rate, for those who know, is just basically what the Federal Reserve charges banks overnight for interest rates. And for most of the pandemic, that has been dead flat. That you can see at the very beginning, there was a very, very sharp contrast when the pandemic started to hit. We said the economy a bunch of money was dumped in there. Interest rates were dropped to basically zero, and it held that way. And now with the threats of inflation and so forth, the Fed funds rate is going up significantly. The Fed funds rate is going up significantly. Now, these things, I would argue, have a very big impact on the mind of the investor. Because the investor's mind today in software and engineering versus 2 years ago is processing this on the understanding that today money is more expensive. I know that sounds strange, but it is. Money is more expensive today than it was 2 years ago when money was getting dumped into the pandemic. Treasury yields are higher. Therefore, there's just less appetite for longer-term investments. And in fact, what we have seen is that from an IPO standpoint, a software IPO, we're looking at the smallest number of IPOs since 2003. So initial public offering is when a company finally goes from private to the public market. In fact, you might even be seeing some trends in the other direction where companies, actually my former employer, FireEye, McAfee combined, went to Trellix. Trellix is now a private company. And that's interesting from a standpoint because all of this is playing into the mind of the investors. They're looking at macroeconomic data plus sentiment, and it's giving them a changed focus. It's giving them a changed focus. I want to underline that word. I almost did it in the deck here, sentiment in our mind. Because sentiment is basically, everything else is kind of like the nuts and bolts and financials and so forth. Sentiment is basically what they're thinking. It's how they're approaching this problem. And all that's leading to a changed focus. But that focus is really looked at in really two directions. So essentially, investors want just two things. They're looking and focused on basically two things: growth and cash flow. Growth and cash flow. Growth in a context where growth matters in revenue. Are you able to increase your sales year over year? That's what they care. That's one of the main pillars that they care about. The second thing that they care about is cash flow. Now, I was very deliberate not to put profit there. And the reason I didn't put profit there is because there's a whole host of metrics to describe how much you're actually looking at, how much the business brings in. Profit, I think, is probably susceptible to more what I'll call financial engineering. Cash flow is just, are you bringing money into business? We're going to take a look at what that means because I think that's actually a better indicator. So those two things, growth in revenue and cash flow the business is bringing in, come together in what's called the Rule of 40. Some of you might have heard this. If you've been in SaaS for any length of time, the Rule of 40 is a very direct type of thing, marrying these two things together. It marries them together. So the first part of it, it looks at LTM growth rate. We're going to talk about what LTM is in a minute here. And the second part, it adds LTM FCF margin. That's the growth for right now, growth and cash flow. And the idea is if you add those two rates together and you get higher than 40, that's a good business. It means usually you're operating pretty well. Your mileage may vary a bit, but that's actually a very critically important, the business is looked at as a positive trend. So put that in the back of your hat. We're going to get back to that in just a little bit here. But I want to focus on just kind of laying the groundwork on what revenue growth rate is. Revenue is potentially maybe the most direct thing. It's the total amount of money a company brings in, not counting what expenses it has to pay out. So it's just basically sales. If you make widgets and you sell them for $10 a piece, you sell 10 widgets, your revenue is $100. It's that simple. Now you have two focuses on that, and that's LTM and NTM. LTM is you basically look back at the financials and you say, what were the last 12 months and how much did we grow? If we went from $100 in revenue to $110 in revenue, we're now at 100. We have a 10% LTM growth rate, revenue growth rate. NTM, next 12 months, is a little bit trickier because obviously they haven't happened yet. So the only way you can figure that out is you can say, what does that company say they're going to do from a growth rate standpoint? Or what do the analysts say from a consensus standpoint about what they expect that company to grow? So it's revenue growth rate can be looked at either historically, going back to LTM, the last 12 months, or over the next 12 months to figure that out. So what does that look like in practice? I have a bunch of these slides kind of peppered throughout that. I've taken some of the big SaaS companies out there and taking a look at what they look like, or big software companies. So the darling of the last probably year and a half, 2 years has probably been Snowflake. Snowflake has had a 92% revenue growth increase over the past 12 months. It is, we're going to take a look at some more of its metrics, but this is one of the ones highlighted there. It's usually at the top of kind of like the unicorn of unicorns list. And they're trending, consensus is that they're going to be somewhere in the neighborhood of 53% growth over the next few years. I actually put ServiceNow in there for a specific reason, because ServiceNow is usually looked at as kind of like a more mature company. It's a company that's been around for a while. You see LTM and NTM actually closer from a 25 and 21% together. And then also HashiCorp, you can also see very similar to kind of the same crop as Snowflake is expecting, maybe a 50% drop off over the last 12 months versus the next 12 months in revenue growth. That should be illustrative for us and have some understanding. Incidentally, I did look at a lot of SaaS companies. I couldn't find a single one that was forecasting higher, of any sizable, of any type of revenue size, that is forecasting the next 12 months higher than the last 12 months. Again, kind of consider that about where the economy is and what we're doing. So, multiples. What does it mean from a multiple standpoint? This is probably, but before we get to multiples, I want to take a look at what equity value is. So if you look at a company and you say, okay, how much is a company worth, EV? Equity value is loosely correlated or about the same as can be used interchangeably with market capitalization. You add up all the stock and add up all the value of the stock. In general, you get how much that company's worth. That's what equity value is. Now, you'll often hear a term called multiple in the software space. Multiple is what that is defined as the company's EV or equity value divided by how much revenue it is. So a multiple, for example, if Acme Corp is trading at $1 billion and their revenue for the past 12 months is $100 million, that means they're trading at a 10x multiple, And those multiples, the higher the multiple, the better confidence the investors have in how well they think that software company is doing, how well they think that's going. So what does that look like, again, in practice? Equity value and multiple. Snowflake today is, or when I took this snapshot, was valued at $38.6 billion, okay? It's trading at a 15.4x multiple. So if you wanted to get its revenue, and I haven't done the math, you would take 38.6 billion, divided it by 15.4, and that's how much revenue it had over the last 12 months. Or what it's expecting to trend over the next 12 months. Again, ServiceNow and HashiCorp, we'll take a little bit look into what that means, but each of those, they each have 8.5x and 6.3x respectively. This gives us an idea about what investors, again, the higher the multiple, the more investors think about the value of that company. So what is that, bringing it back to the overall, I'm going to take us back to the treasury rate, okay? The light blue there that's actually trending up over the next several years, over the last, I'd say 18 months, is that 10-year treasury rate again. The dark blue line that's trending down is the median multiple of SaaS companies. So what does that tell you? That when treasury and money gets more expensive, multiples go down. Treasury gets more expensive, money gets more expensive, multiples of software companies go down. And that's happened consistently over the past years. We find ourselves in a place right now that's really not that much different. So if you see the straight line is is actually the median multiple that was pre-COVID. So what's interesting, if you look on the far right of that, in August of 2022 of this year, the median multiples of software companies are below what they were in COVID, below what they were trading from multiple standpoint from COVID. So again, perspective, perspective, perspective. All right, moving on to the second half of that side of the rule of 40. We're looking at something called LTM FCF margin. Now, FCF simply stands for free cash flow. That's it. I mean, that's basically what it is. And I've kind of crudely said, free cash flow is money to do stuff with. It is, you take your sales, you subtract your taxes, you subtract your payroll, you subtract your buildings, you subtract any other type of capital expenditures, and you get your free cash flow. And the reason investors like FCF or free cash flow is because it allows the business to do interesting things with all of that money. One of the things it lets them do, potentially, is buy back stock. So the stock that you hold as a shareholder is more valuable because the pool is less. Or it allows you to pay dividends. So they can take that free cash flow, they get a big pile of money, and they pay it back to all the investors, and it goes from there. All right. Again, going back to our three examples, what does that look like? Snowflake is generating about 20% revenue, free cash flow over revenue. So that means for every $100 of revenue, $20 of it is coming back as just basically cash back to the business. ServiceNow you see, but you also see HashiCorp, which is ballpark and actually losing money. So it's detracting that. That's not a commentary on the value of that company, by the way. But the column to the right is growth plus free cash flow. That is the rule of 40. That is the rule of 40. So remember going back, if those two numbers, free cash flow plus growth in revenue, are higher than 40, usually that has been seen as a positive business model. So what you have is HashiCorp is not doing bad at 26%. ServiceNow is north of 40, so it's at 53%, and you almost have Snowflake as a 3x times that. So that's, and right now at least they're knocking it out of the park. That is the rule of 40, and that's the understanding of how revenue and free cash flow relate to each other. And that's what, because the growth in free cash flow is so high, that's usually directly correlated to what investors think that a company is worth from a value standpoint. Now, let's get back to that quote. At this point, I think we've dissected a bit what revenue is. We understand what LTM is. We understand the last 12 months growth rate. We understand what free cash flow is and how that comes back to the business. Now I want us to take a look at R&D and S&M. Essentially, when you have this idea, most of us have probably heard the term operating expense, or abbreviated OpEx. OpEx is really three different categories of expenses the business has. Those three categories, research and development, sales and marketing, general administrative. So the way a company breaks that down and brings it together, research and development is usually what we are. We're the ones who are building the products and building those things which the company goes forward and sells. Research and development. Usually it sounds, so software development expenses, licensing and so forth related to building that software, that's what research and development is. Sales and marketing is even more straightforward. It's just what you pay your sales and marketing team to go tell people about the product and all the administrative stuff to go buy the product. And finally, general administrative is what I'll call all those undifferentiated corporate functions, your HR, your finance, your accounting, your corporate IT, your security, the whole bit. G&A is just the bucket of what, like, not necessarily germane to what the business is doing. Now, the allocation and distribution of those three buckets from an operating expense standpoint is what analysts will look at when they look at that business. And here's what it is. Over the last, I would say, since 2017, 73 SaaS companies have gone public. The median data point for what those companies are spending on research and development is 26%. So for every $100 of revenue they're bringing in, the median data point is $26. The median data point for sales and marketing is $48. And the median for that $100 of revenue on the G&A side is $22. Now, we're going to play a little bit with R&D and S&M as we go in this presentation, but in general, G&A you want to get low. There's really only one direction that you want to push G&A, and that's actually lower. But R&D and S&M is where the businesses make or break. So is that all? No, there's actually a fourth bucket, but it's not really included in operating expense. And I want to cover that quickly here so we have something understanding. It's actually an acronym that's held over from some of the manufacturing pieces on this, and that's called COGS, cost of goods sold. It's basically what it takes to build or ship or run the product. If you're in a SaaS company and what you're paying, your public cloud bill, your Amazon, Azure, GCP, whatever that is, that's usually what you're doing from a production standpoint is what you're paying is probably one of, if not the greatest contributor to COGS. If you have a customer support function, if you have licensing that directly supports that, those are all some of the pieces there. And COGS is important from a margin standpoint because gross margins equals revenue subtracted from COGS. So when I was, several years ago, I went through and I sat down with the executive. We were starting up a new product in a company. We're kind of almost like a startup inside of a larger company. And the executive that was running our product at the time, we were bootstrapping it. He came back and he related a conversation he had with the CEO. CEO said, "I see your product's growing, but you're diluting my margins." And he said, "Well, what do you mean by that?" "Well, all of the other products I'm selling right now have really fat margins. The product that you're shipping has very, very low margins. It's, we're spending, for every dollar of revenue, it was like $90 or $95 of COGS. It was very, very low, small COGS." And he said, "You need to stop doing that." And that actually triggered a whole type of a workflow for us because we had to find out a cheaper way to deliver the product. Even though we were a very small percentage of the revenue of the overall company, like the CEO took us to task on our dilution of the margins. And that translates into real engineering work. Right? That translated into real engineering work. This was no joke. This actually had an impact, a material impact on the equity of the company, the value that our shareholders would get. So what is a good margin? I actually took this is, in some ways, I'm going to preface this with an asterisk. This is a little bit of a self-serving graph for the company that put it out there. I'm not going to say who did it, but I do think it's actually relatively interesting. So we're back to our friend multiples. And what we see is that trend line is based on based on what your gross margins are, what it's telling us is companies with higher gross margins usually have higher multiples. Now you can see there's a couple multiples up near 40. This was clearly not done this year, but this actually graph is about a year and a half old. But I think it actually still holds true. So that basically what it's saying is the higher your margins are, in other words, the cheaper it is to deliver your product, likely the better off your multiple is going to be. In other words, investors will look favorably on that. So let's actually get down a little bit, take it one cut lower, and get into something called customer metrics. These are very specific. These will, I think, kind of getting at a deeper level into the business, but still very important because investors will look at that. Now, when I was talking to one of the CEOs that I had working with, he highlighted on the analyst report, he said, LTV over CAC is greater than 5. We need to feed the machine. What in the world does that mean? Feed the machine. It's trying to understand how that actually made a difference. But that, again, this is what he was thinking. So I went back and I take a look. His favorite metric was LTV over CAC. And I want to break with that down and why that's important from an executive standpoint, from a CEO, to say, this is why this is important. So LTV is nothing more than lifetime value of a customer. And you take that lifetime value, what the average revenue is from that customer per year, you figure how long that customer is going to be a customer, and then you subtract churn rate. So if you're making $100 per year per customer, and they stay with you on average 5 years, and the churn rate's 20%, so 1 in 5 customers is going to leave you in that 5 years, you have basically a LTV of $400. $500, $100 a year times 5 minus the churn rate, so you're at $400. That's how you figure out long-term value of a customer. And the customer acquisition cost, or CAC, is also very important, because what that tells us is how expensive is it for the business to go out to acquire a customer. That has nothing to do with research and development, but everything to do with sales and marketing. And very straightforward, you say, I would like to look at, like, for example, the last quarter of the last year. How much did I spend on sales and marketing? Divide that by how many customers I have, and then that's really how much it costs to acquire a customer. So if, for example, I have $50 spent on sales, $50 on marketing, and I acquire 10 customers over the last quarter, my customer acquisition cost is $10. It's that straightforward. And when you put long-term value or lifetime value over CAC, customer acquisition cost, you get a ratio that tells you, should I keep going after more customers? When that's very high, it tells the business, yes, I want to keep spending money on sales and marketing, because every time I get a customer, that customer is helping me for very, very high long-term value, lifetime value. And so when we got to this idea of feeding the machine, what feeding the machine meant was our sales and marketing can bring in very, very profitable customers, start putting money from sales and marketing. And what that translated that to, as being an engineering leader, is that we had to defund in some capacity research and development. Interesting problem. Not something you like to see, and it certainly wasn't the challenge that I was really thrilled to have coming into this. But when you're looking at research and development, really, we said earlier, G&A, the other bucket of operating expense, that needs to be as low as it possibly can anyway. You don't want to deal with that. That has to be low. So if you want to actually maintain your free cash flow margins, you have a very good LTV over CAC, you take it from really the only bucket in the company, which is R&D, and you start funding S&M. So the assumption is that you usually fund S&M growth after a business grows with research and development. And if you look at many of the startups, it's very, very interesting. You could look at a startup as it goes through a maturity phase. Early on, it's all R&D. You're building the product, building the product, building the product. And then as you start selling the product, you kind of hit steady state, which is about 25%. We saw the median, 26% of R&D over revenue. And then you start cranking up sales and marketing. And that's when the product starts to come in. You start making sales. But some of that may be changing a bit. And the reason I say it might be changing a bit is this concept that's been a buzzword lately, PLG, product-led growth. PLG is something that's beat up a little bit on the streets, but it is something that actually might be changing that. And I'll go a little bit of a tangent, and I'll explain why PLG might have some impact on us. So traditionally, the way you get customers, and this is a funnel, there's a funnel, the business will look at something and they'll say, okay, we want qualified leads of customers. There's informational marketing and sales. What that is, that's from order of the least likely from a prospect to turn into a customer to the most likely. And finally, the hope is after you get a sales qualified lead, that salesperson calls the customer up, they send the emails, they translate from a prospect to actually a customer. That has been the basic funnel for the longest time. That's how business was done, and that is still, by and large, the right way, not the right way, but the way that businesses in the software space will kind of grade it. Usually they instrument that funnel. If you're chief marketing officer or whoever's running worldwide sales, what have you, will actually have some of these statistics and understand what that looks like. PLG gives us this parallel, kind of separate funnel, which is something along the lines of product qualified lead, a product qualified lead, or PQL. That has worked its way into the vernacular of SaaS metrics and some of the speak on the business side. And it's essentially saying this, that the product itself has the ability to actually pull a customer in. How does it do that? One of the ways it does that is something called reverse trials. So if you've ever experienced this, you might say, okay, I get a product full capabilities for 14 days or a month. And you get that for free, a freemium model or a free model. Then I translate over after that time if I don't buy to I would say the free tier, a truncated capabilities, and then you're there. But at that point, whoever's building that product knows all kinds of things about you, all kinds of things about your business. They know what you're doing, how you're using it. And so that product, if it's easily accessible and you can find it with low friction, what it has done is it's taking a customer or a prospect customer through the product and now potentially put them at the other side of that line as a product qualified lead. That is the essence and the heart. You're going to see, if you read any of the trade industries, you'll see PLG has been, probably the last 18 months, has been the buzzword, really, really hot. It's driving a lot of the perspective here. So from our standpoint, the next slide I'm going to qualify before I show you it, because I was very selective with the metrics that I picked, but I do want to show them to you because this actually translates into what's real. One company that's more legacy and one company that's considered PLG. So ServiceNow spends 39% of their revenue on sales and marketing. And they spent about industry benchmark 24% on research and development. Now, if you've ever used Datadog, you'll know that they have a very different model. They're one of the newer companies that's come in kind of close to Snowflake up there as one of these unicorn recent SaaS companies. They are spending almost the exact opposite. 28% on sales and marketing, and 42% on research and development. Why? Because their product has freemium models, capabilities, it pulls you in, it's very consumption-based. Much of their funnel is coming in from usage of the product. And that's the trend. And the reason that R&D is higher is because they have not transitioned from, for example, saying, okay, we have a product, go sell go fund sales and marketing to go tell people about it and bring in leads and so forth. They've said, no, we're going to double down on research and development. We're going to make the product so it's attractive. We're going to go out there and say, offer the freemium case, bring people in from a consumption standpoint, and then drive it. So their flip on the margins, it's very different. I'm going to come back to this at the end because there's very specific ties in for us as engineers. Understand that there is opportunities for us as software engineers to drive both top-line revenue and customer acquisition. And that's showing up more and more. I think it's valuable for us to have that understanding. So this idea of PLG has brought forth probably one of the more popular metrics that's in the SaaS space right now. It's something called NDR. Net dollar retention, I quoted an analyst here, net dollar retention is arguably the most important measure in SaaS. What is NDR? NDR is when net dollar retention is the annual recurring revenue, ARR, plus whatever upgrades are there, minus whatever the downgrades and the churn are. So unlike some of the other metrics, which just indiscriminately look at revenue, NDR looks at annual recurring revenue. Why is annual recurring revenue better? Because it means the customer is basically more sticky. They're paying you every month from a consumption standpoint or maybe a subscription standpoint. It's not like you're just churning out perpetual licenses every once in a while and you really have no tie-in back to that. The general dogma on the street is if your NDR is higher than 130%, you're rocking it. That drives very high multiples. And again, back to our companies here. Who's doing well from an NDR standpoint? All these companies. ServiceNow, actually, I couldn't find something specific on them, but I swapped out Twilio. 3 very, very healthy companies from an NDR standpoint. It means that the stickiest part of their revenue, what's going to give them longevity, is actually increasing at a phenomenal rate. The business is actively growing. Well, at this point in the presentation, I think we've looked at a lot of that. This is we've looked at R&D over revenue. We understood that R&D over revenue should have some type of, early on it should be high, but if the growth rate isn't there, it doesn't justify it. LTV over CAC, we understand that that's a function or a quotient of how well you can, how profitable it is for you to attract customers. We understand that feeding the machine, that S&M, while maintaining FCF are all important. So I think we've dissected this quote or this summary pretty good, and I want to take us back now, just as I kind of wrap up the presentation, to what I would say is some of the perspective on where the industry is right now and why this is important. So here's just in general my perspective about what the industry is right now and potentially where we're going. Back to 2007 to 2009, Q4 2007 to Q2 2009, that period of time, there was 5 to 10% unemployment. We're currently at 3.5. There was a lot fewer SaaS companies out there, but even though their rate of growth fell, they were still growing during the recession. It's interesting to think about. Those SaaS companies were still growing during the recession. And what they were doing, the median, their operating margin, they were all becoming more efficient. So they were still growing, but growing slower, but their operating margin went from 3 to 9%, which says that they're actually growing, they're actually getting more efficient. They used the, I guess you say, they used the recession to help make them more efficient and get the businesses in better health. I also want us to recognize that I know not all of us are in software companies, not all of us are part of cloud, but I think a lot of us are adjacent to it. The global cloud TAM, or total addressable market that we live in right now, which is basically all of the, if you add up all of the potential revenue in cloud space, is $500 billion. $500 billion. And with a 20% growth, compound annual growth rate, which is basically how much are we growing? The industry is growing at 20% or expected to grow at 20% over the next 7 years. All right, that means in the very near future, we are going to be sitting on a $1 trillion plus market of what we're doing. All right, I think that's important for us to have perspective, because the pessimism and the concern and all that type of thing that's happening now, the reality is nobody's really questioning what the cloud is going to do. There's tons and tons and tons of TAM left, opportunities to develop businesses, get efficiencies, find new customers in the cloud space. And so where that takes us is that both we are growing as an industry, but we're also normalizing. We're also normalizing. And that normalization is found, I think, in this next chart, which is a bit of an eye chart, but I think this is my favorite slide. This is from the 2022 OpenView SaaS report. And what this tells us is this. So if you look at the slide there, on the left-hand side, what the author did was they looked at something called historical R-squares, which is nothing more than a correlation of two data sets. They said, back in September of 2021, the correlation between the next 12 months growth and the multiple of that company, this is a function of what do investors think is worth. This is the sentiment of investors I was telling you about. What do investors think about the value of the company? The strongest indicator of what they would value in the form of a multiple of a company was how fast the company was growing. How fast is that company growing? And since September of 2021 to June of 2022, that correlation, the strength of that correlation, has dropped 48%. On the flip side, the idea of this rule of 40, which is a much more balanced approach of looking at both last 12 months growth and the free cash flow, has increased significantly. 81% it's gone up between September of 2021 and June of 2022. So it tells us investors are now, at least in the SaaS space, much more, I would say, balanced and focused on the overall holistic picture of the companies that they're investing in. That's where we're at today. And I think this has a lot of positives for us as a business and us in the software space. Because for going back to PLG, when consumption is the consumption model, the licensing model, I didn't spend a lot of time on this, but we've gone from perpetual licenses to subscription to consumption. When that is closer to it, when it's better, much more aligned with what the actually customers are doing, I think you get more efficient growth. I think you get more efficient growth because you have better instrumentation and telemetry. What is the customer actually doing with the product you're selling them? And therefore it leads to better investment of capital, which is my next one. So the tighter investment, the tighter funding means we're a lot more discerning on what the capital is. This is probably one of the most provocative things I'm going to say, but I'll qualify this here. I had an opportunity to talk with a particular individual, executive, whatever, at, I guess it was somewhere deep, like in the middle of the pandemic. And the verbiage I got was, investors are literally just throwing money at startups, just throwing money. Ridiculous multiples, 20, 30, 40, 50x of what they're making revenues. And it was like, you know, how easy is this system to game, right? How easy is this system to game? That really benefits no customers. That benefits nobody. At that period of time, money was so cheap, they were looking for somewhere to put their money, which I don't think was really a good thing for the economy or even the people who are building the products, because it went to like a very false sense of value, right? We are coming out of a time that's much, I think was, to use a quote from Economists are rationally exuberant. But the third point there is that what I'm seeing is that because you have a more balanced, holistic viewpoint of the investors looking at this, it's very similar. Like if we're the kind of DevOps or Agile philosophy, you have to have, the idea is you tighten the iteration cycle, build software, get the value out that, get the value, understand the value, and iterate in smaller chunks. When you balance cash flow with growth, that's exactly what you're doing. You're looking at a perspective. I don't just care about growth in your grand plans. I care about, are you balanced, growing, but also successful in the current market that you're at? So again, this is maybe the macroeconomic picture is modeling what we've known in DevOps for a while. So finally, engineering agency is what I bucket all of us into as I close this. What I would encourage all of us to do is three things. First of all, understand the business. We as engineers, I think it helps us to understand what the people outside, what our, not just our, both our customers and what our investors, our kind of two big stakeholders, care about. If we don't, we come off, and I can't tell you how many times I've seen this, where engineers, well-intentioned engineers, will come off, they'll make a suggestion, and it is dead in the water at the beginning, as soon as the words leave their mouth. And the reason is because they're so far divorced from what the actual business cares about. I hate to tell you this, but the CEOs of our companies, they have bosses, they're investors. The executives have to answer to them, and many times we should try as best we can to understand holistically what the business is doing. The second thing is to collaborate with the business. What excites me about some of the metrics that matter more, particularly the NDR, the net dollar retention, is that it is a function of not just, for example, engineering efficiency or sales and marketing. The old dogma used to be this. It was sales and marketing's job to get net new logos or get new customers into the door. That's the original. And then it was engineering's job to keep them. So the engineers' jobs was to keep churn low. That's actually going away. There's tighter collaboration now between sales, marketing, engineering, and product management. I think that's a really, really healthy thing. And it tells us, so what are the things that we should build? We should look at other models. How do you make consumption easier for your customers? How do you make the experience with as least friction as possible? How do you make it so people on the other side of the business to conduct experiments with the products that we're building and get the analytics that they actually care about to make wise business decisions, and then incentivize the right things up the chain to the executive branch, to the executives in the suite. And finally, I'm going to say own the business. And what I mean by own the business is this. Probably to the frustration of a lot of the product management people that I worked with on the other side of the aisle, so to speak, I always demanded what actually is the revenue, upside, retention, churn rate. Give us a metric on what this is going to do. What is legitimately the value prop of that, of this feature, of this new product we're going to launch? Take that. I remember one of the executives I worked for, he had, just like we were getting together as a team, and there's this giant number, $500 million on the screen. He was the CTO of the company at the time. That was what the consensus, that's what basically his number was. He said, I own that number. I own that number. And that really struck me as something like, well, okay, isn't there sales and marketing? No. He took the ownership and he said, I own that number. And I think we would do well as software engineers, particularly when there's this much volatility in the market, to understand the business, collaborate with the business, and make sure that we're taking over the right amount of ownership as much as we possibly can. Because I think with PLG and some of the other trends, the future is engineering running the overall focus of the business. All right, I think I finished up here. So we have, I appreciate everybody's attention. I think we're like 4 minutes. If we have any questions, Alex, we can take them afterwards, but it's all good. All right. Thank you all.
Great job.
Thanks, man.
Yeah, thanks so much, Chris. At Atlassian, we were recently talking about the Rule of 40. So it's like when he talked about possibly coming up here and talking about the Rule of 40 and the finances and technology really interested me. Do you want to do Q&A, or is that?
Yeah. If anybody has any questions, I can take a couple here if we have time. Or we can wait. Okay. Yeah. Yeah, informational, which was basically a customer comes into the website, just wants information. That's an informational qualified leader. And then there was marketing qualified lead, which is those capabilities that, like for example, if your marketing team does some type of specific campaign, you see a bunch of the vendors out there that might be, if you get a name from there, that might be somebody that's an MQL. And then finally, they hand those over to the salespeople, and the salespeople will vet them like, hey, did this individual have budget? Do they care about things? Is it the right fit? All that kind of stuff. So it's IQL, MQL, SQL is the general funnel, or what has been historically. Sir?
So towards the end, you were talking ownership, and especially as engineers, we want to introduce people, right?
Yep.
We love that, but we want to make it compelling. Can you elaborate a little bit more on how we would present to you? Kind of touched on like, what's the profit on this? What does it actually mean to the business? How do we help align that? How do we be more aware of that?
I think so this is something done in collaboration with product management. So they have to understand what the customers are asking for. So first of all, does your product have the right instrumentation, the analytics to actually understand how the customer is using it? So that might maybe like retrospective, backward looking. One of the things is, collecting and then forward looking. Are you collecting data points on what the customer actually might be doing? I didn't dig deep into this, but one of the things many of these companies have, they have really good instrumentation on what their what segment their customers are in, what they care about, what their workloads are, what the expectation, how much more are they consuming year over year, that type of thing. So I think those are some of the biggest pieces to drive that. I remember having having a conversation. We said, the product management team said, well, our churn rate's X, it needs to be Y, because this is how it's going to impact revenue. If we can just drop it 5 percentage points, it's going to have a $20 million impact on our overall revenue. And I think that's also a key. The other key I would say, and I'd actually cut this slide because I think it's a lot more to get into, but margins have two sides. One of them is there's top line and bottom line. The environment we're in now, everybody's focused on bottom line, cut your consumption, cut your consumption, cut your consumption. The reality is, I'm hoping, and this is easier said than done, but do we as engineers, are we thinking about opportunities to increase the top line? Because as soon as you get into this is a zero-sum game, you can only cut expenses so much and that type of thing. So I think you have to have a balance. Thank you for that question. Shut up. Any questions? Yes, sir.
I'd always thought that software development within the company is I'd always thought that software development within the company is considered CapEx, and that I work in infrastructure and operations, and it always felt like operating expense, just kind of keeping the lights on in terms of how it was invested in. But you said that it sounded like you were saying that the software development is actually OpEx.
No, it's R&D usually, and R&D would be in the bucket of operation expense. Now, I don't know, some businesses, depending on where they're at, might actually treat that differently, especially if you're not in software. If you're for example, if you're doing software development as part of corporate IT, you're building, for example, integrations between your backend, ERM system or whatever, that might be a little bit different. But I think to your point, it's some of that's an excellent point. But usually, if you're shipping a product, research and development is going to be, and this is one of the reasons they bucketize it, is it's all, there's tax benefits from driving that. So from a revenue standpoint, yeah, good question. Thank you.
You hit on a really good topic about how business and engineering need to be aligned. Mm-hmm. What would you say? What words of advice would you give for technical leaders that want to connect better, have a better relationship with product management, technical program managers, things like that?
I think that the biggest thing is to collaboratively own the problem. There's shoulders on both sides of the road. I'm going to say engineering dealing with product management. One side of the road is you just play over dead and you're the order taker, right? It's just build X, okay, and just charge right in, right? When it's absurdly false. The other side of the road is you're belligerent and you say no to everything and you don't do that. I've seen the best engineering leaders are staying in the middle, collaborating, asking hard questions, which is eventually going to put pressure. Depending on what the product manager experiences you're working on, they might not like you asking questions. And I don't know, this is also found this very interesting. Culturally, there's this thing where either it's an engineering culture or a product management culture in the R&D side of the house, and whatever one it is, there's a dominant player and a submissive one, right? And if you show up as the engineer to a dominant product management culture, it's and you start asking questions, I mean, who are you dealing with? So I guess my only general advice I can give you is stay the middle of the road, ask tough questions, yet be collaborative, because if you show yourself as actually, hey, I want to solve these problems with you, That's a big deal, right? Like that might be completely anathema to what they've seen over the past their history, where it's like the only thing that engineering says is it's going to take longer. Yeah. Other questions, comments? Very good. Yes, sir.
Free cash flow and just net profit.
Yeah.
I didn't really see a distinction between that.
I think one of the things that, okay, I'll give you probably the biggest distinction, right? Free cash flow, you subtract capital expenditures from it, like off the cuff. So for example, if you spend $10 million that year on buying like a new data center or racks or something, that immediately comes off FCF. Like there is no depreciation or amortization of that like expense over the long term of business. And again, I'm getting a little bit out of my depth here because I'm not an accountant, I'm just a software engineer. But like it's the free cash flow. There is also, you probably heard the term EBITDA, earnings before interest and tax, right? And all that. That's also kind of takes in this consideration. It's a equalizer because different businesses pay different services on debts. Like for example, you might be angel investing and pay very high on how much you're servicing your debt, or you might have different bank load rates and so forth on that. So it tries to essentially stabilize or normalize that, so the investors can look at it as how much cash is your business bringing in minus whatever sweet deals you have with, or lack thereof, with your investors. And if you have to spend big capital expenditures, free cash flow you take that hit immediately. The first year, that's it, no questions asked. Versus, I think if you're looking at like, again, I'm way out of my depth here, but if you're looking at like profit from a GAAP standpoint, you would have the luxury of depreciating long-term assets over the course, and that would have a more favorable effect on your profit. Don't record that, no. Yes, sir. Yeah.
And predicting about 20% over 7 years and all that. When you refer to that, are you talking about SaaS, or are you talking about the infrastructure and platform?
Infrastructure as well, because I mean, you actually bring up a really good point, right? Because of that $500 billion today, AWS is like an $80 billion run rate, right? So that's like, 15% of that already. You put the hyperscalers in, they're probably going to be already a third of that, right? And then you put the top 5, you're there close. But I think it's just an aggregate. I did try to find like similar type of things. If you look at SaaS or software in general, it's somewhere in like the 15 to 20% CAGR as well. So for whatever that's worth. Are you good? That's good enough. Thank you all. I appreciate the questions. Thank you.
Thanks so much, Chris.
Thanks, man.
Good job, man.